Unofficially, the Dow stands at 1738.41, a drop of more than 508 points.
Certainly, we haven't priced that in right yet. The verdict is not yet in. I think you could probably look at the washout conditions in the market and start to make a case that there's been enough selling for now.
If we get a second wave of selling, we'll be there. You know, I've been writing for 4 weeks about that 1,000 point, maybe 2,000 point bottom.
Boeing was a $400 stock last summer. It closed today at $129 and change.
In last week's video, I explained the reasons why I believe that there will be a stock market crash in 2021. So in today's video, I'm going to study all the previous stock market crashes in the past 40 years and see if we can give us a clue on when the stock market will crash in 2021. Most importantly, stick to the end as I'm going to outline the exact chart setup that I'm looking for that could confirm that the US stock market is about to crash this year. Hey traders, this is Mike Sir here. I've been an active trader for over 21 years and a trader coach for the past 15 years. In this video, I'm going to share with you my research on all the stock market crashes that we experienced in the past 40 years and then compare them to the current US stock market. So what I'm going to do for each stock market crash is share with you what was the major catalyst for the crash, how much the market dropped, and the technical chart setup that I see that led to its major decline. First, let's start off with Black Monday, October 19th, 1987.
They called it Black Monday. By 4 p.m., the market had dropped 508 points, the biggest plummet since the crash of '29.
Now, many people blame the cause of the crash to be computer program-driven trading models that followed a portfolio insurance strategy. At the time, trading done by computers was still relatively new, and the consequences of a system capable of placing thousands of orders during a crash had never been tested. The portfolio insurance strategy was to hedge a portfolio of stocks against market risk by short selling stock index futures. The objective was to limit the losses a portfolio might experience as stocks decline in price without that portfolio manager having to sell off those stocks. However, because the stock index futures were falling, the computer programs automatically began to liquidate individual stocks as well, due to certain risk levels being breached, which also caused the domino effect of pushing prices even lower. The frantic program selling dragged markets into a downward spiral as the computers turned off all buy orders at the same time when sell orders were triggered. This was very similar to what happened on May 6, 2010. Some of you, like myself, were trading on that particular day.
Down 400 very quickly and then down 800, nearly 1,000 in a heartbeat.
I mean, it is classic capitulation.
There are some people who are proposing there was some kind of fat finger error.
We have commodities that are being crushed.
There may have been a bad print in Procter & Gamble.
This is very much 1987.
The biggest single widening day since we
There was panic selling on the way down, and all of a sudden it just stopped on a...
The cause of the crash cannot be attributed to any single news event since no major news event was released the weekend preceding the crash. However, there were some warning signs. First off, there was a widening trade deficit that weakened the US dollar, and this led to selling of US dollar denominated stocks. Now, the selling wasn't a huge surprise given that the stock market at the time was near all-time highs and company valuations were very, very rich, given company forecasted earnings were declining. In addition, interest rates were rising while economic growth was slowing, not a very good combination. Now let's take a look at the charts and analyze what happened. So here's a chart of the S&P 500 index from 1985 to about 1988. So what I did here is I drew a lot of trend lines, a lot of support and resistance levels, and what I was trying to do is trying to analyze what happened in terms of the 1987 Black Monday crash. So you can see here the price has been basically going up ever since. You can see that I drew some trend lines extending all the way out here and here as well. You can see that the price basically has been moving in a kind of an upward channel. You can see that every time it hit this level, try to go again, you can see its resistance level, come back here to hit support, right? Hugging this support line here. And then finally in about 1987 January, it finally broke out this range. And then if you see this line that extended, hit this level of resistance, pull back, didn't go back to this support level here, and then basically kept going higher. And it hit this resistance level here, went a little bit above, and this is the area that we want to focus on. So I'm going to zoom in here a little bit more so you guys can see. So what this is I drew some trend lines extending out here. You can see a high here, lower high here. You can see a support level here. Every time that hit this level, it bounced back up. You can see here. So this type of chart pattern is a descending triangle. So it's making lower highs, but it's basically hitting this support level, and then finally on October 14th here, it broke this support level, and that's why it caused this big drop. And then also here, this support level has been in existence or since 1985, extend all the way out, and then finally again it broke here. So that's one of the reasons why, if you look at it from a technical point of view, is that we had a very negative chart pattern, a descending triangle, broke this pattern, broke this long-term trend line, and that's one of the analysis that I look at in terms of identifying this type of a chart setup for a stock market crash. Let's look at another stock market crash that is referred to as the dot-com bubble, which lasted between March 2000 to October 2002. This period is known as the internet bubble, caused by the excessive speculation of internet-related companies in the late 1990s, such as Pets.com and WorldCom, which both went out of business. During this period, internet or tech stocks, which had gone parabolic, saw their stock prices decline on average 80% or go to zero. For someone who was a trader throughout this time period, it was the commercialization of the internet that excited so many traders like myself who saw their fortunes grow and disappear in a matter of a year. The main reason for the crash was due to the high valuations of technology startups that raised millions of dollars but had no sound business plan, product, or the ability to make a profit. Once investors realized that they couldn't keep funding these money-losing companies, the companies ran out of money and went under. Now, does this remind you of a recent time period?
And it was definitely like one of the many signs that I saw around the same time that, crypto isn't just a toy anymore. It's a significant part of this new world that's being created.
Along with sky-high valuation for companies which didn't even make money, the Fed Chair Alan Greenspan warned the markets about their irrational exuberance on December 5th, 1996.
How do we know when irrational exuberance has unduly escalated asset values, which then become subject to unexpected and prolonged contractions?
But he did not tighten monetary policy until the spring of 2000. This was when he raised interest rates several times, and these actions were believed by many to have caused the bursting of the dot-com bubble. Okay, so let's take a look at the charts again and see what happened. So again, here's the chart of the S&P 500 index from 1995 all the way to 2001. And you can see, again, I drew some trend lines here, extended all the way out. Since 1995, the S&P 500 index basically has been going up. It's been actually going up very steadily, not too much volatility. You can see here, a little bit of a drop here, but you can see clearly the S&P 500 index was very strong. So this is an area that we want to focus on because this was actually a very bullish pattern. So let me extend this out here a little bit more, or zoom this out. So for those who know chart patterns, this is basically an ascending triangle. You see lows here, higher lows, higher lows, higher lows, and then you have a resistance level. So in actuality, this type of pattern actually should break out. It's actually a very bullish pattern. But what actually ended up happening is the pattern broke. So the pattern dropped through this support level here, this trend line that extended out, and ever since then it couldn't retain or couldn't go back above to these highs here. And then we can also see here it's a double top here as well. So it fell, it broke this long-term trend line here. Extend this out. You can see it broke this trend line here, and it got very, very choppy. You can see here, very, very choppy. But the biggest thing is it was a failed bullish pattern. So technically it should go up. The fact that it didn't go up with a bullish pattern was a warning sign, and hence afterwards, once it broke this level here, it was never able to go back up to that same level. You can see it tried again for the second time here, but ever since then it's basically been making lower highs, right? High here, lower high, lower high, lower high. So this upward trend pattern has been broken, and then it started transitioning to a downward pattern. Another dark period in the financial markets was the global financial crisis between 2008 and 2009. Now, before I talk about the financial crisis, please stick around till the end of the video as I will analyze the current state of the US stock market and see if we can find an opportunity to profit from the fall in the US markets. Also, if you don't mind, please smash the like button for the YouTube algorithm so I can share this video to as many people as possible. Okay, let's get back to talking about the financial crisis in 2008. This period is known for the epic financial and economic collapse that cost millions of people around the world their jobs, entire life savings, and their homes. It is considered to be the most severe financial crisis since the Great Depression, and the markets reflected that. The Dow Jones Industrial Average, which is a good barometer of the health of the US stock market, would fall 54% from its 2007 peak in a matter of 17 months. For someone who also traded throughout this time period, it was the low interest rate and lax regulatory environment that fueled a housing price bubble in which anyone could get a mortgage. The cause of the crash was the financial institutions who fueled the housing bubble suddenly were left holding trillions of dollars worth of near worthless investments in subprime mortgages.
A's, 0. B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
What is that?
That's America's housing market.
The Fed started raising rates in June 2004 to try to cool the red-hot economy, and 2 years later, the federal funds rate had reached 5.25%, where it remained until August 2007.
When the number of risky subprime mortgages skyrocketed. When housing prices fell and higher interest rates kicked in, homeowners couldn't keep up with their payments.
Foreclosures are rising, and the biggest problem is that prices continue to drop. Until home prices stop falling, things just aren't going to get any better.
So let's take a look at the charts again and analyze what happened. Again, this is a chart of the S&P 500 index, essentially from about 2003 all the way to 2009. So after the dot-com crash, the markets basically stabilized. You can see here around 2002, 2003 had a triple bottom here, hit this level 3 times. And ever since then, the market has reacted or responded very, very strongly. And ever since 2004, 2005 here, I drew this trend line here, it basically, the market has been going up. Now, this is an area that is a concern. Basically, the peak in 2007. So even though the markets were basically still going up, it hit a double top right here and essentially was going sideways. Okay, it wasn't continuing to go up. And what it did here, which again I drew a line here, it hit this support level, which is right here. Okay, and then you can see if I extended this trend line here, it actually hit this level and actually broke. So that was a huge warning sign in terms of a market crash. Now, it did try several times, and then actually finally it went up, but it actually went back up to this level here, which is now a resistance line. And ever since then the markets plummeted. You can see here. So the warning sign was the fact here that it broke this major support level. It tried to go back above it, but it couldn't, and then it failed, and hence the markets basically collapsed soon after that. Let's take a look at the current state of the US economy and see how it compares to the conditions of past stock markets and see if there is indeed a crash coming. Now, before we talk about the similarities, please take a moment to like this video. I would really appreciate your support. Okay, let me outline the current state of the US economy. Now, we're currently at all-time highs in the US stock market. We have sky-high company valuations. We have a red-hot real estate market. We have a prolonged low interest rate environment. We're seeing signs of inflation and rising inflation. We see possible interest rate hikes in the next year or so. So let me ask you a question. Did we have all these types of conditions in the US economy prior to a stock market crash? Please leave your comments below and let me know what you think. As we looked at the technical charts last week, we still haven't seen a breakdown in the US stock market, and prices still seem to be going up. So the question is, what are we looking for in the charts that can tell us the crash is coming? Well, let's look at the charts. So here's again a chart of the S&P 500 index from 2012 all the way to July 2021. And I drew this trend line here, again, extending it all the way out here. So you can see this market has essentially been on a very, very strong upward market for almost 9 years now, with not any major correction at all. You can see some bit of a correction here in 2018, and then obviously here with the COVID pandemic, but you can see obviously how strongly it has rebounded. And we're basically very, very far away from this long-term support line here. So let's analyze a little bit closer from about 2018 to about 2021. Let's take a little closer here and see what we can find out. So you can see here, I extended all the way out here, drew some trend lines here. Basically has been trading in this range besides these drop here. You can see that finally in about late 2020, early 2021, the market really broke out. Okay, you can see here, it broke out here, right here, went back to test it, support, and then came back to test it again, went up a bit, went back to test this, again, could not break support here, tried again, and then finally, after the market can see that this is a very strong support level, that's why the market really skyrocketed after March 2021, you can see here. Now, one thing that is a bit of a concern is if you are a market technician analyzing charts here, this is what we call a wedge pattern. Okay, you can see that the gaps are actually getting tighter and tighter. You can see here, basically trading with this range, getting tighter and tighter and tighter. And essentially, this is a very negative chart pattern. So what this pattern indicates to me is that we have to be very careful once it breaks this line right here. Okay, extend it all the way out here. And as of today, we are very close to that. Let me extend this and zoom out a little bit more. So we're kind of right in the middle here. So if we break this level here, there's a big chance that we could see a significant correction. Now, where that correction will be, we don't know. But if we were to just base purely on this charts here, this is a very strong support level. You can see here, it has basically gone down to these levels and hasn't broken through. So if we were to break this line right here, probably my first target in terms of the direction where the S&P 500 is going to go is to around the 3,800 level. All right. And if we do break this level, which is quite significant, then we could go back into this range here. You can see this range. And again, if we do get out of this range here, then we could, again, I don't know whether we're going to test the lows in the COVID pandemic here, But if we do break this line here, we should see a significant correction. Thanks for watching. If you like this video, please smash the like button for the YouTube algorithm, hit the subscribe button to watch more videos like this, and hit the notification button so you'll be notified of future videos.